In this week's video, we'll review the latest charts and data to help us answer the question: after the bears get whipsawed, what does it mean for stocks? We'll be moving quickly, so feel free to use the pause button on your video player. In last week's video, we talked about the importance of not overreacting to short-term volatility within the context of a long-term uptrend. And we cited numerous charts in the April 19th video, including the one on your screen, gold GLD relative to SPY, that again told us this looked more like a pullback or a correction within the context of an uptrend. Gold had done a lot of very nice things in isolation, but this chart here said not much had changed from a relative perspective when we compared it to stocks. If we fast forward a week, during the session on Friday, April 26, GLD was underperforming SPY for the week by 4.73%. This small cap chart from the April 19th video is used to illustrate that while small caps were pulling back, if anything, this looked like potentially an attractive risk-reward entry point from a long-term perspective, with price holding above numerous important anchored volume weighted average price lines. Buyers did step in this week near this region. During Friday's session, IWM small caps was up 2.65% for the week. In terms of our extremely conservative allocation to small caps, chart on your screen dated April 26th, Friday, April 26th, small caps relative to the S&P 500, says at this point we're in no rush to make any changes to that conservative allocation. 2 weeks ago, in the April 12th video, we used the chart on the left side of your screen to illustrate that it wouldn't be particularly abnormal or concerning if the S&P 500 came back to this anchored volume weighted average price line here in purple, tied to the beginning of the calendar year or the last trading day of 2023. If that didn't hold, we might come down to this orange line tied to the October low from last year, or the second purple line tied to the high in the summer of 2023. And the model scores that we covered in last week's video told us to try to avoid overreacting to the current pullback by keeping in mind that being overly concerned about the drawdowns on the left side of your screen, that can be the enemy of capturing long-term returns within the context of a secular trend. And on April 12th, we knew if the market pulled back here, here, or here, that would have ended up representing approximately a 5, 8, or 11% correction, which is not particularly unusual within the context of long-term, all the way back to 1928 S&P 500 history. Thus, on Friday, April 26th, after some significant risk-off behavior last week, it's fair to ask and answer, where do we stand relative to the first purple line intraday on April 26th? There's three versions of the line here, tied to this high, tied to the last trading day of the year, and tied to this low here early in 2024. And as you can see, we did overshoot all three of those lines on a closing basis last week during that decidedly lopsided period of risk-off behavior. And we did mention in last week's video that it's not unusual for the market to overshoot on a short-term basis, and right now, it's possible that that's what we have. During Friday's session on April 26, we were above all three of those lines tied to late 2023, early 2024. This is a daily anchored volume weighted average price chart. That's why we have the expression, the longer below, the more relevant it becomes. And that also applies up here, the longer above, the more relevant it becomes. This is a step in the right direction. In terms of resuming this uptrend here, next step would be to break this downward sloping trend line in this area here. On a short-term basis, we would put this into the so far so good category. There's still some work to do. The numbers on the top of your screen are late in the session on Friday, April 26th. You can see the VIX trading back down around 15. The S&P 500 finished up approximately 51 points on Friday. And taking a weekly reading at 1:46 p.m. on April 26th, the S&P 500 bounced back 144 points this week. Now remember, in last week's video, we said XLK did not go down last summer in a straight line, so it's possible that this is a counter trend move within the context of a short-term downtrend. So we'll learn something if we can break that downward sloping trend line and move in this direction. And we'll learn something if we take out this low here and fail to hold these anchored volume weighted average price lines tied to late 2023, early 2024. 100% of this week's video is being recorded after the close on Friday, April 26th. Thus, we'll be moving along quickly, trying to shift our focus back to our long-term research project. We've covered this ratio, energy relative to tech, several times over the past few weeks. This is the bear market look that we want to avoid. This is the correction look in 2023. This is the look thus far during the current pullback. If we zoom in on this area here and place a chart on the left side of your screen, this is what the same chart looks like during the session on April 26th. As noted in previous weeks, if the ratio breaks above these lines here, that would be concerning or more concerning for the stock market bulls. It happens to coincide with the downward sloping trend line from this high and this high, as well as the anchored volume weighted average price lines that acted as resistance last summer. This region here is this region here. Now let's talk about the concept of this being a counter trend rally within the context of an ongoing intermediate or short-term downtrend relative to the end of this pullback. We'll go back to the XLE XLK chart. We're going to focus on this area here. This area here, this green diamond where my cursor is the same as this area here, the green diamond on the right side of your screen. And that's where the S&P 500 correction ended. You'll notice if we go to the zoomed in version over here, that's when the ratio crossed below the black anchored volume weighted average price line tied to this low here. So correction ends when you get this look here, least relative to 2023. The similar line would be this bottom mustard colored line here, and you can see we're well above it. So we're somewhat still in no man's land. Haven't broken out above this area in a bearish manner. Still in the correction type zone, but we haven't made a move yet that makes you feel more confident relative to this ratio that the correction is over. So we'll see how it unfolds. If, and that's not a prediction, the line moves in this direction and the ratio breaks the mustard line and leaves this white space here, that would be a good sign relative to inflation. If we go up and tag this area here and make a move like this, probably fair to say that concerns about inflation are similar to concerns about inflation back here. We're long-term investors. The most important thing for us is the look of this ratio is not particularly scary at the moment, just as it was last week, not particularly scary, relative to the long-term primary uptrend in the stock market. If you're a stock market bull and you review stock market history, all things being equal, you would prefer to see the NASDAQ outperform the S&P 500. Chart on your screen is just that. It's the NASDAQ composite relative to the S&P 500 index. As we've mentioned in past videos, if this ratio can get out into this area here, which would be similar to what the S&P 500 did in May of last year, that would be bullish. This too is somewhat in no man's land, but thus far we've made a stand at this blue anchored volume weighted average price line, anchored to point C here, where price made a similar stand after a short-term overshoot in 2023. Right here we held here again later in 2023. We're also well above the mustard colored anchored volume weighted average price tied to this low here late in 2022. And again, that's for the ratio of the NASDAQ relative to the S&P 500. This high here and this low here also relevant. So you can see we're at a very important area here. Bullish if we get out here, more concerning if we get down here. Longer below, the more concerning it would become. Longer above, the more bullish it would become. Given we're still in an uptrend off of this low here, it's probably fair to say the longer term odds still favor resolution to the upside, but we'll see how it plays out. Since this pullback here in the S&P 500 and the move higher in the XLE XLK ratio are both tied to concerns about inflation, The comments on your screen from John Furner, the Walmart CEO, this week regarding the topic of inflation also tell us to keep an open mind about this ratio, the NASDAQ relative to the S&P 500, resolving to the upside. That may happen. Hasn't happened yet. But the longer-term bullish scenario is also supported by the DeMark counts that we covered in the April 12th video, 1995. Really good things happen for a long period of time. 2003, good things happen for a long period of time. I've seen something similar in 2024. The chart of RSP, the equal weight S&P 500 that we covered in last week's video, also tends to align with resolution to the upside, or a bullish longer-term resolution. Last week we said this setup here for RSP was not particularly intimidating from a risk-reward perspective. With price above an upward sloping 250-day moving average in black down here, and last week during this pullback still holding above this region here of prior resistance that dates all the way back to late 2021, early 2022. And we can learn a lot about longer-term odds. The odds of good things happening relative to the odds of bad things happening by examining a simple daily chart of the S&P 500 during the session on Friday, April 26th. This is price here. We have the 20-day moving average in blue all the way out to the 250-day moving average in black. The chart goes back to 2021, lower left-hand corner of your screen. In the present day, this is the type of trend rollover look early in 2022, the bear market, that we would like to avoid. And more specifically, this clustering look in here. Notice, back here, when the trend is still strong and it's still up, notice the distance between price here and the slowest moving average, the 250-day. And then notice the white space and the nice clean stack between the moving averages. That's a strong uptrend look. Contrast that, the distance between price and the 250-day moving average, with the distance between price and the 250-day moving average in late Q1 of 2022, early Q2 of 2022, right before the market took another and significant leg down in the 2022 bear market. This is significantly different relative to this. And it's fair to say on April 26th, probably look a lot more over here on the right-hand side of the screen. This looks a lot more like the strong trend look here and really hasn't evolved much into a look as concerning as this. The severity of the change in here is greater relative to the severity of the change in here, but that doesn't make this easier over here. We have similar deterioration. This is the approximately 10% correction in the S&P 500 that occurred in 2023. One big red flag would be that 250-day moving average in black rolling over as it did in this region here. Contrast that with the slope of the same 250-day moving average when we had the short stay below during the correction last year, and the slope of the same 250-day moving average in black over here on the right side of the screen on April 26th. This really doesn't look anything like this. A few weeks ago, we mentioned the market's much more vulnerable from a trend perspective, and a numerical perspective, and a mathematical perspective in here during this correction relative to where we are today. And that can be seen in numerous ways, including that the pullback that we just had over the last 2 weeks, we've had a bounce this week, all of this is occurring above this level back here from 2022. The market was in an indecisive and confused state for the most part during all of 2022 and for the most part during all of 2023. This is early 2022 here, lower left-hand corner of the blue box. This is early 2024 here, lower right-hand corner of the box. And you can see this correction that we've had here, this pullback that we've had, this corrective price action against the primary trend. This is a counter trend move thus far. All of it occurring above this level. And we know The longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. Periods of indecisiveness are really marked by a lot of volatility and very little progress point to point. We can draw a horizontal line from December of 2020 and hit price again in October of 2022. We can do the same here in April of 2021. Price comes all the way back to that level in Q4 of 2023. Up here, we've got price September, August 2021. Price is at the exact same level in Q4 of last year. We really can't do that from where price sits on April 26th. If we draw a similar line in here, it's just going to hit a bunch of white space or dead air over here. So the longer we stay above this black box that spans approximately 3 full calendar years, the higher the probability that this strong trend look that we have here, that's very similar to this strong trend look over here, will continue. And hopefully the difference here is this is the look at the end of a move, followed by indecisiveness and consolidation inside the black box. You can make an argument that this looks like the early stages of a long-term uptrend. In terms of asset allocation and a leadership perspective, this is January 1st, 2024. You can see regional banks, for numerous reasons tied to inflation, interest rates, and the debts and loans that they have on the books, for the most part, has been underperforming VU or SPY the entire calendar year. The same can be said for RSP, the equal weight S&P 500, relative to VU and SPY, the S&P 500 ETFs. Contrast the slope of the 250-day moving average for this ratio in black here and the slope of the 250-day moving average for this ratio here with the slope of the 250-day moving average in black shown here for growth stocks, SCHG relative to VU. If we use VUG divided by SPY, we would have almost the identical chart. Thus far, we've been consolidating within the context of an uptrend. All of this has been happening above an upward sloping 250-day moving average. This starting to look a little bit tighter and a little bit more concerning from a leadership perspective. But given the look during the session on April 26th, this is still an uptrend. And thus far, the recent low is similar to this low, this low, this low, and this low. And relative to this topic here, right side of your screen, and more importantly, this topic, not becoming overly concerned about 100% normal and to be expected pullbacks that occur within the context of a secular trend, for our time frame, it's relevant that the ETFs shown on your screen, growth, the S&P 500, XLK, tech, the triple Qs, the NASDAQ 100, economically sensitive and interest rate sensitive and demographically sensitive home builders, ITB, small caps. We don't like them from a leadership or overweight perspective, but they too are showing some promise from a longer term perspective. The same can be said for RSP, the equal weight S&P 500. Right now, the relevant topic for our long-term investment time horizon is that thus far, all of this corrective activity or counter-trend type activity in here has been occurring well above an upward sloping 250-day moving average in black. And that's true for every single one of these ETFs. And that looks like a primary uptrend. And it looks like one of the stronger portions, stronger trending portions of a very long-term primary uptrend. And these numbers down here as of April 26, very similar to last week, tell us we still look like we're in one of those blue boxes. The blue box is one of the stronger portions of a secular or long-term uptrend. Really pleased with what we're seeing during this long-term research project. And given that we like what we're seeing, probably fair to rephrase this as we think we can complete the next phase of this project between late June and late August. And I phrase it that way because the years that we've examined thus far, they tell us that we possibly are building a model that could be useful for the rest of our investing lives. And we all know if we're going to effectively utilize these shorter-term charts relative to this rally attempt within the context of this very short-term corrective process thus far, and do it effectively within the context of these still healthy long-term uptrends, it's important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.